Welcome. Let's continue getting you ready to pass the Securities Industry Essentials, or SIE exam. Most folks who invest their money are hoping for a profit, or at least a positive return. In this segment, we'll talk about the different ways investors measure how well their stock or bond investments are performing. These returns might show up as periodic dividends paid on stocks, or as interest paid on bonds. Another way investors see returns is through any change in the value of their investment, whether that's appreciation or sometimes depreciation, from the time they buy to the time they sell. And by the end of this segment, we'll take a look at benchmarks, which a lot of investors use to compare how their investments are stacking up. Now let's talk about return on equity investments. Earlier in the series, we mentioned that by buying a corporation's equity securities, you actually become a part owner of that corporation. Sometimes corporations decide to share their earnings with shareholders by paying dividends. It's important to remember, though, that dividend payments are voluntary, unlike bond interest payments, which are mandatory. Moving on to dividends. Common stockholders don't get a specific annual dividend. Instead, the board of directors decides what dividends, if any, the company can pay to its common shareholders. Dividends are paid out on a per-share basis, and when it comes to dividends, there are three important dates that the paying corporation sets. First up, the declaration date. That's the date when the dividend is officially authorized. So, if a company's board declares a 10-cent dividend, stockholders as of a certain date will get 10 cents for each share they own. Next, we have the payment date. This is when the declared dividend is actually paid out. Dividends are usually paid quarterly, and they're taxable in the year you receive them. Finally, there's the record date. That's the date when you must officially own the stock to be entitled to receive the dividend. For example, on December 1st, the Board of Widgets Incorporated declares a dividend of $1 per share that's payable on January 3rd to shareholders of record on December 15th. Any person who is on Widget Corporation's records as a shareholder as of December 15th will receive the $1 per share dividend on January 3rd. Ex-dividend rule. Although a corporation's board of directors sets the declaration, payment, and record dates, the ex-dividend date is set by the SRO for the market on which the stock trades, like, for example, FINRA. The ex-dividend date represents the date on which a stock begins to trade without its dividend. A stock will typically trade ex-dividend 1 business day prior to the record date, or, record date minus 1 business day. So ultimately, an individual who purchases a stock for regular way settlement, that's trade date plus 2 business days, or T plus 2, either on or after the ex-dividend date, will not be entitled to the quarterly cash dividend since they will not own the stock by the record date. For example, on Monday, April 25th, the board of directors of XYZ Corporation declares a 60-cent dividend which will be paid on Friday, May 27th, to all stockholders of record on May 12th. The stock will trade ex-dividend on Wednesday, May 11th, which is 1 business day prior to the record date. Assuming a 2 business day settlement, any trade that's executed on May 11th will not settle until May 13th, which is the day after the record date. Therefore, investors who purchase XYZ stock on or after May 11th will not be entitled to the dividend. The ex-dividend date represents the first day that a stock begins to trade without its dividend. Therefore, on the ex-dividend date, the stock's price will be reduced by an amount equal to the dividend to be paid. For example, if a stock paying a 50-cent dividend closes at $20 per share on the day before the ex-date, it will open at a price of $19.50 on the ex-dividend date. For any dividend that's a fractional amount, the reduction must cover the full dividend. So, like a dividend of 12.5 cents results in a reduction of 13 cents. Let's talk about due bills. If a trade is executed before the ex-dividend date, the buyer is entitled to the dividend. However, if the seller fails to deliver the securities by the record date, the seller will remain the shareholder of record for the dividend payment. The seller will receive the dividend but will not be entitled to it. Therefore, good delivery rules require a due bill to accompany the stock, creating a liability for the seller and a receivable for the buyer. Using the calendar from the previous example with a record date of Thursday, May 12th, if an investor purchases stock on Tuesday, May 10th, the transaction will settle in 2 business days. Thursday, May 12th. The buyer will receive the dividend because the transfer agent will be made aware of the new owner's name in time to change the shareholder's record for the upcoming dividend. Because the stock trades ex-dividend on Wednesday, May 11th, from that date forward, the buyer will be able to purchase the stock at a price that doesn't include the dividend. A due bill will be required only if the buyer purchases the stock before the ex-date, but the seller delivers the security after the record date. Now, using cash settlement, a buyer may still obtain the dividend after the normal ex-date by purchasing the security and using a cash or same-day settlement on a date up to and including the record date. In the preceding example, if the investor buys for cash as late as Thursday, May 12th, she's entitled to the dividend. In this case, the price of the stock is adjusted to reflect the buyer's receipt of the dividend. For a cash settlement trade, the ex-dividend date is the business day following the record date. Stock dividends. Rather than making a cash distribution, a company may elect to pay a dividend to its shareholders in the form of additional shares of stock. For example, let's say an investor bought 100 shares of Widget Inc. for $80 per share. Therefore, his cost basis is $8,000. If Widget Inc. declares a 10% stock dividend, the investor will be entitled to an additional 10 shares, 100 times 10%. Unlike ordinary cash dividends, stock dividends are not taxable until the shares are subsequently sold. Ultimately, the investor will hold an increased number of shares, but at a reduced price per share. Although this form of distribution is not taxable, the IRS requires the investor to adjust her cost basis on the stock as follows. The original cost basis is $80 per share, which is $8,000 divided by 100 original shares. The adjusted cost basis is $72.72 per share, which is $8,000 divided by 110 current shares. Calculating current yield or dividend yield. For stocks, the current yield is its annual return based on its annual dividend and current price, as opposed to its original price or face value. The formula for calculating a stock's current yield is its annualized dividend divided by its current market price. For example, if XYZ stock is trading at $50 per share and has a quarterly dividend of 25 cents, its current yield is 2%. Since dividends are typically paid quarterly, the 25-cent dividend must be multiplied by 4 to determine the annualized dividend income. Return on bond investments. As described in an earlier video, when an issuer sells bonds, it's obligated to make consistent interest payments to the bondholders who allow it to borrow their money. This fixed rate of interest is also referred to as the bond's coupon rate. Remember, regardless of whether a bond is purchased at a premium, par, or discount price, its interest rate is always based on its par value of $1,000. The basic formula for determining the dollar amount of interest paid each year is the bond's coupon rate multiplied by its par value. Example 1. If a client purchases a 6% corporate bond and pays $875, she will receive $60 per year. $1,000 times 6% equals $60. Example 2. If a client purchases an 8% corporate bond and pays $1,000, she will receive $80 per year. $1,000 times 8% equals $80. Example 3. If a client purchases a 9% corporate bond and pays $1,100, she will receive $90 per year. $1,000 times 9% equals $90. Prices and yields have, an inverse relationship. As previously mentioned, a bond's coupon or interest rate is generally fixed for its life. So, as market interest rates change, new bonds will be issued with either higher or lower coupon rates than those paid by existing bonds. To keep pace with current interest rates, the value of existing bonds will need to change. As interest rates rise, the value or price of existing bonds will fall, since the demand for existing bonds that offer lower interest rates will decline. Conversely, if interest rates fall, the value or price of existing bonds will rise, since they're worth more than new bonds being issued with lower coupons. To summarize, as interest rates increase, the prices of existing bonds decrease, and as interest rates decrease, the prices of existing bonds increase. Understanding this fundamental inverse relationship between market interest rates and existing bond prices is really the first step in determining what an investor actually earns. The simple discussion regarding the amount of interest a bondholder receives by multiplying the par value by the coupon rate may be, well, insufficient. Since investors will likely purchase bonds in the secondary market at a price other than par value, when considering their actual return on investment, they'll need to account for the price difference and the subsequent return of par at maturity. Calculating bond yields is, honestly, something every bondholder cares about. Like other investors, bondholders are interested in determining their investment's return, or yield. There are three different measures for determining a bond's yield: nominal yield, current yield, and yield to maturity. So, let's talk about nominal yield. A bond's nominal yield is actually the same as its coupon rate. For example, if a bondholder purchases a 6% bond, her nominal yield is 6% no matter what price she paid for it. Nominal yield is honestly the simplest measurement of return, but since it doesn't account for whether the bond was bought at a premium or a discount, it's really just a starting point for the yield discussion. Now, moving on to current yield. Current yield basically measures what a bond investor receives each year based on her potential purchase price. While the nominal yield is tied to a bond's par value, current yield is actually based on the bond's current market price. To calculate current yield, you just divide the bond's annual interest payment by its current market price. Since a bond's nominal yield is fixed, if an investor purchases a 10% bond, she'll receive $100 per year. That's $1,000 times 10%. But the actual current yield she earns will depend on the price she pays for the bond. Determining and analyzing a bond's current yield helps an investor get a better sense of what she's earning on the bond. However, current yield doesn't take into account the payment she'll receive at maturity. If an investor buys a bond at a price other than par, the difference between what she paid, whether that's a premium or a discount, and the par value she gets at maturity has to be considered to figure out the bond's overall yield. That's where yield to maturity, or YTM, comes in. Yield to maturity includes everything an investor receives on a bond from the time she buys it until it finally matures. This covers the bond's interest payments, plus the difference between what she paid for the bond and what she gets back at maturity, which is usually the par value. So, here's the thing. An investor who purchases a bond at par will receive her money back at maturity. Now, if an investor buys a bond at a discount, she'll profit since she paid less for the bond than its par value. Conversely, an investor who purchases a bond at a premium will actually incur a loss because she paid more than the bond's par value. Take note, the calculation of yield to maturity, or YTM, is pretty complex and, honestly, not required to be calculated for exam purposes. Instead, the focus should really be on understanding the concept. Basis. A bond's yield to maturity is simply referred to as its yield or basis. So, a 7.44% yield to maturity, a 7.44% yield, and a 7.44 basis are all, synonymous. The term basis is actually derived from one method of expressing yield. 1 basis point is equal to 1/100th of 1%, so a 1% difference in yield equals 100 basis points. Basis points may be used to compare the yields of two different bonds. For example, if bond A is trading at a 4.55 basis and bond B is trading at a 4.95 basis, then bond B is trading 40 basis points higher than bond A. If an investor purchased bond B with a 4.95 basis, it would provide a pickup yield of 40 basis points over bond A call provisions. Some bonds may include a call provision that allows the issuer to redeem or call the outstanding bonds before they reach their final maturity. If called, the issuer is often required to pay the bondholders more than the par value to compensate them for the early redemption of the bonds. This additional amount is referred to as a call premium. This event obviously impacts the bondholder's return since he's receiving more than par and receiving it prior to the bond's expected maturity. Yield to call, or YTC. The yield to call represents a bond's yield if it's called prior to maturity. For callable bonds, there's uncertainty as to whether the bond will be called. For that reason, when the bond's yield is quoted to an investor, both the yield to call and yield to maturity must be calculated. regulations stipulate that the yield disclosed to investors must be the lower of the two yields. This conservative return estimate is referred to as providing the bond's yield to worst. If a bond is trading at a discount, the yield to call is higher than the yield to maturity. However, if a bond is trading at a premium and callable at par, the yield to maturity is higher than the yield to call. Cost basis, capital events, and return of capital. So far, the primary focus has been on the effect of interest and dividend payments for investors. But what happens if the value of investors' underlying investment rises or falls? Well, if the investor has not yet sold, there's no taxable event. In other words, these unrealized capital gains or losses, sometimes called paper profits or losses, have no impact on the investor's tax situation. On the other hand, if the gains or losses are realized, they must be reported on the investor's tax filing. Now, cost basis refers to the total amount that an investor has paid to purchase a security. The calculation typically includes the commissions or other fees paid to the brokerage firm when the securities are purchased. Some securities make distributions that can be reinvested to purchase additional securities. An investor's total cost basis will increase as he is required to pay tax on the distribution. Investors often need assistance in determining their basis in a security. For example, if a person inherits securities, the beneficiary's basis is the market value of the securities on the date of the original owner's death, or the net asset value on the date of death if mutual fund shares are received. By receiving the market value at the time of death, the beneficiary has a higher or stepped-up cost basis, which reduces his potential capital gain. Brokerage firms assist investors with calculating cost basis by sending an IRS Form 1099, which provides useful tax-related information. Capital gains are generated when an investment is sold for a price greater than its cost basis. If the investment has been held for 1 year or less prior to its sale, the gain is considered short-term and is taxed at the same rate as the investor's ordinary income or marginal tax rate. However, if the investment has been held for more than 1 year prior to its sale, the gain is classified as long-term and is taxed at a lower rate. Currently, the maximum rate for taxing long-term gains is 20%. Now, capital losses arise when an investment is sold for a price lower than its cost basis. Similar to capital gains, if an investment has been held for 1 year or less before its sale, the loss is considered short-term. If the asset has been held for more than 1 year prior to its sale, the loss is classified as long-term. Capital losses can be used to offset capital gains. So, let's talk about return of capital. A return of capital happens when an investor gets back a portion of her original investment. Since this type of payment isn't considered income or capital gain, it's actually not a taxable event. And any return of capital will lower an investor's cost basis because she now has less money at risk. Now, when it comes to measuring return, many investors look at their investment return in relation to the amount of risk they're taking on, while others might compare their returns to a specific benchmark they've chosen. In this section, we're going to take a look at some of the more popular ways people measure return. Okay, so total return is a key concept here. The total return calculation takes into account all the cash flow you get from dividends and interest, along with any increase or decrease in the value of your investment. This return is shown as a percentage, and it's usually calculated over a 1 year period. The total return on an investment is calculated as follows. So let's look at an example. An investor purchases 1,000 shares of VPN at $25 per share. VPN pays an annual dividend of 80 cents. After 1 year, the stock's market value declines to $23 per share. What do you think is the investor's total return? In this example, the investor's total purchase amounts to $25,000. However, after 1 year, the stock's value has dropped to $23,000. During the year, the company paid a dividend of 80 cents per share. So the investor received $800, 1,000 shares times 80 cents. The investor's total return calculation is shown below. The investor has a loss of 4.8%. Now let's talk about the inflation-adjusted rate of return. The inflation-adjusted rate of return, also known as the real interest rate, measures the true yield of a fixed income payment after accounting for the effects of inflation. Something to remember here, the inflation-adjusted rate of return is simply the actual return minus the rate of inflation. Here's another example. ABC Corporation's bond has a nominal yield of 8%. If the inflation rate is 3%, what is the bond's inflation-adjusted rate of return? Based on the formula shown above, the inflation-adjusted rate of return is 5%, 8% minus 3%. Alright, so let's talk about risk-free return. The risk-free return is basically the return you get on an investment that carries, well, no risk at all. Usually the rate of return on a US Treasury bill or T-bill is used to represent this risk-free return. But, sometimes the rate of return on a 10-year US Treasury note might be used as an alternative depending on the situation. Now, moving on to risk-adjusted return. The risk-adjusted return looks at how much an investment returns compared to the risk you take on to achieve that return. For exam purposes, you don't really need to calculate the risk-adjusted return, but it's still pretty important to have at least a basic understanding of the concept and what goes into it. So, averages and indexes, let's break that down a bit. Investors will often compare how they're doing to a specific benchmark. That benchmark might be an average or an index that tracks how a group of securities is performing. Some indexes are broad-based, meaning they try to reflect the entire market, while others are narrow-based and measure just a segment of the market or a specific industry. Now let's go over the Dow Jones averages. The Dow Jones Composite Average is made up of 65 stocks, and it's split into 3 sub-averages. First, there's the Dow Jones Industrial Average, which includes 30 stocks. Then, there's the Dow Jones Transportation Average, consisting of 20 stocks. And finally, the Dow Jones Utility Average, which is made up of 15 stocks. Of the 3 sub-averages, the Dow Jones Industrial Average, or DJIA, is the most frequently quoted measure of the stock market. The DJIA encompasses 30 of the leading blue-chip companies that represent the backbone of U.S. industry. This average includes companies such as Apple, General Electric, IBM, and Microsoft. The Standard & Poor's 500 Index. The S&P 500 Index contains stocks that are listed on the NYSE and NASDAQ. Compared to the Dow Jones averages, the S&P 500 provides a broader measure of the market and consists of approximately 400 industrial stocks, 20 transportation stocks, 40 financial stocks, and 40 utility stocks. The New York Stock Exchange Composite Index. The NYSE Composite Index contains all common stocks listed on the New York Stock Exchange. The index is further divided into 4 sub-indexes for industrial, transportation, financial, and utility issues. So let's talk about the Wilshire Associates Equity Index. This index is made up of stocks that are traded on both the New York Stock Exchange and the NASDAQ. The Wilshire Index actually represents the total dollar value of all those stocks, and, it's considered the broadest of all the indexes and averages out there. Alright, moving on to some other equity indices. The Major Market Index is made up of 20 well-known, highly capitalized stocks. Then there's the NASDAQ Composite Index, which includes all the securities listed on NASDAQ, while the NASDAQ 100 is made up of 100 of the largest companies listed there. And finally, the Russell Index tracks 2,000 small-cap company stocks, making it, well, the benchmark for the small-cap segment of the market. Debt or bond indices. In addition to equity indices, there are also benchmarks for debt securities. For example, Barclays Capital and other brokerage firms have created several indices based on various types of debt securities in the market. There are also municipal bond indices created by the Bond Buyer, a financial publication that specializes in the municipal market. Tracking performance. One of the most important things for an investor to track is how their investments are performing relative to a benchmark or index. For instance, what if their equity portfolio had increased by 5% over the last 12 months, but the S&P 500 index was up 10% during that same period? In this case, the investor should examine the individual stocks in their portfolio to determine the necessary alterations. This concludes the examination of investment returns. The next few videos will cover several popular packaged products such as mutual funds, exchange-traded funds, and annuities. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but significant support for us, and it is entirely free. Please turn on your notifications to be among the first to be introduced to mutual funds, exchange-traded funds, and annuities to excel in the SIE exam. Thanks.